All right, today we're going to dig into an equity research report on Nebius Group. And honestly, it's a real head-scratcher. You've got these financials that look absolutely wild, but the market's reaction? It was the complete opposite of what you'd expect. So, let's get right into it. Okay, so let's dive right into the mystery. Nebius, right? They're a huge player in AI infrastructure, and they just dropped their quarterly earnings. The numbers were just staggering. But, and this is the key part, for completely opposite reasons. So first up, look at this, the big headline number, revenue. We're talking an incredible 355% explosion in year-over-year growth. I mean, wow, that's the kind of hypergrowth that usually sends a stock straight to the moon, right?
But then, at the very same time, the company reports this, a massive and widening net loss of nearly $120 million. Now, if you just saw that number on its own, it would scream total disaster.
So, what do you do with that? You've got this rocket ship growth on one hand and a sea of red ink on the other. So what did the market do? It sold. The stock dropped a full 7% on the day they announced all this. So, what is going on here? Seriously, this apparent contradiction is the absolute core of our story. I mean, how can a company with that much growth get punished by the market? Let's start by unpacking what the investors on the surface were seeing. Yeah, to really understand that 7% drop, we got to look at the two numbers that really spooked the market and triggered that knee-jerk reaction to just hit the sell button. And this slide, it really lays it out. It shows how the market was just priced for absolute perfection. First off, that massive revenue number, well, it was actually about $4 million short of what Wall Street was expecting. A tiny, tiny miss, but a miss nonetheless. And second, that scary $120 million net loss, that was the big, scary headline number that made it look like the business was just burning cash like crazy. But, and this is where it gets interesting, the research report we're looking at argues that focusing on those 2 points is a classic case of missing the forest for the trees. The analysts say the real story, the one that changes everything, was buried just underneath all that noise. And this slide just illustrates that disconnect perfectly. The market was looking backward, right? Punishing a tiny little quarterly miss. But the analysts, they were looking forward, focusing on something announced at the same time, a brand new $3 billion contract with Meta. Yeah, you heard that right. That's 1,000 times bigger than the revenue miss. So, okay, what about that huge loss then? Well, it turns out it wasn't some kind of operational failure. Almost $100 million of it was something called a non-cash depreciation charge. Basically, it's an accounting thing for their massive new data centers coming online. You can think of it like this. When you buy a new car, it loses value the second you drive it off the lot. You haven't spent any new cash, but on paper, it's a loss. That's kind of what's happening here. In fact, if you look at a much better metric for the company's actual operational health, it's called adjusted IBIDA, which basically measures their performance. It tells the complete opposite story. That number actually improved by 89% year over year, which shows the company is, rapidly heading towards being profitable. Okay, so this all begs the question, right? How is Nebius even operating at this kind of scale? I mean, how does a company like this go out and secure multi-billion-dollar deals from the biggest tech giants on the entire planet? Well, the answer is all in its business model. Nebius is what's called a Neocloud. So unlike an Amazon or a Microsoft, it doesn't try to be everything to everyone. Nope. It is purpose-built from the ground up for one single thing, providing the massive, high-performance computing power that you need to run today's crazy AI models. And here is the ultimate proof that this model is working. The big cloud providers, like Microsoft, they're actually Nebius's main competitors. But, and this is wild, the demand for AI infrastructure is so insane right now that even they can't build it fast enough. So what are they doing? They're outsourcing their most urgent needs to Nebius. They're literally turning their biggest competitors into their largest customers. That's a powerful signal. So this is the crucial point, you guys. Nebius isn't just building these massive, incredibly extensive data centers on a whim, just hoping customers will show up. No way. They are building to fulfill $20.4 billion in secured, guaranteed long-term contracts from 2 of the most solid, creditworthy companies in the world. And this whole thing creates this incredibly powerful growth loop, this flywheel. Just look at the steps here.
They build the best specialized AI infrastructure, which then lets them win these giant contracts. Then they can take those rock-solid contracts to the bank to get financing, which they then use to, you guessed it, fund even more infrastructure. See how it works? Each step de-risks and fuels the next one. It's brilliant. Okay, but let's be real. The analyst report is super clear that this isn't some simple, perfect story. The opportunity is absolutely massive, for sure. But the stock and the strategy itself come with some pretty significant risks that you just can't ignore.
First things first, the stock is not cheap. Not at all. If you look at estimated 2027 sales, Nebius, or NBIS, is trading at a 75% valuation premium compared to its closest competitor, a company called CoreWeave. What that means is investors are paying 75% more for every single dollar of Nebius's future sales. That leaves very, very little room for any mistakes.
And that execution, it has to be absolutely flawless. I mean, they're spending $5 billion on construction in 2025 alone. Any delay, and I mean any delay, in getting permits, getting power hooked up, getting those critical GPUs from NVIDIA, it could be catastrophic for them. On top of that, all this growth is being funded by selling new shares, which, dilutes the value for existing shareholders. And finally, you have to remember, this window of opportunity won't stay open forever. The big guys, the hyperscalers, they'll eventually catch up. So after laying out this incredible growth story on one side, and these very real, very significant risks on the other, what's the final verdict from the report? Where do the analysts land? Well, the verdict is pretty clear. The market got it wrong. That big sell-off was, in their view, a profound misreading of the situation. The report basically concludes that while investors are correctly seeing the risk from all the spending, that cash burn, they're completely failing to appreciate the certainty of the $20.4 billion in revenue that all the spending is guaranteed to generate. It's contract-backed. So, their final buy rating is really built on these 5 core pillars. 1, the revenue is de-risked by those huge contracts. 2, their tech is best in class, an AI-native stack that wins deals. 3, the path to profitability is super clear, with these incredible software-like 70% gross margins. 4, their massive growth plan is fully funded. And 5, and this is the key, that initial sell-off created an opportunity, a valuation disconnect that was just caused by short-term market noise. And that really leaves us with the essential question at the heart of this whole analysis, the thing you should really be thinking about. Is the market missing the boat on the next AI infrastructure giant? The company providing the picks and shovels for this new digital gold rush? Or is it correctly pricing in the absolutely enormous risk of trying to build it, even with all those contracts in hand? That right there is the multi-billion-dollar question.